Continuing with our financial statement analysis discussion, let's talk about liquidity ratios. These numbers represent a company's ability to meet short-term obligations. A current ratio below 1 indicates potential trouble. A quick ratio is influenced greatly by the amount of inventory of the firm. So inventory-heavy businesses like car manufacturers often rely on the quick ratio since inventory might not convert to cash very quickly. It's a more conservative measure, if you will. So making comparison across industries may not be as important as looking at competitors. The cash ratio will usually be very low. It essentially tells us how much money we have in our checking account to cover all of our outstanding bills. And if you think about your own situation, you know that relatively speaking, that number at any one point in time is probably a relatively low number, unfortunately. So increasing numbers reflect more safety. Companies are being a little bit more conservative and less risky. So here, the current ratio is less than 1 as we look across the table. So this could be a bad sign of an inability to pay our bills on time. Or it just shows that the company has some cash management issues that it must control very closely. I do not think Coors has any issue paying its debt, but it is a possible issue and certainly a concern of investors and creditors. The difference between the current ratio and the quick ratio reflect the amount of inventory in the company. Looking at the lines in this graph, we can see that there's not much difference in the trends or distance between them. So we can conclude that the amount of inventory itself does not seem to change much over time. The cash ratio seems to be relatively stable. It basically assumes or implies that the company keeps a set amount of cash on hand to cover whatever its current obligations might be. Debt management ratios reflected the amount of leverage a company uses. And we need to address two separate issues. How much debt does the company have? The debt ratio describes the amount of assets purchased using debt. If 60% of the assets were used purchasing debt, that implies 40% were purchased using shareholder money. The debt equity ratio reflects management's choices between long-term and shareholder money. If management has decided that they want to borrow a lot more money long-term, this number can be higher. Again, how much debt we have. The higher the number, the greater the leverage, the greater the risk we have, and as we'll find out a little bit later, potentially the greater the profits that could go to our shareholders. The second thing we want to address, though, is our ability to cover the amount of debt we have. It really doesn't matter how much debt we have. If we can't pay the interest and principal, then we have a problem. So these numbers reflect the safety we have in making our payments. The times interest earned ratio, for example, reveals whether a company can comfortably service its debt. Companies like Coca-Cola with stable cash flows maintain strong coverage ratios. The debt ratio and the financial leverage multiplier are similar. One is the reciprocal of the other. So you can see that they also reflect the same basic shape in our graph here. They're very, very similar. So increasing the debt ratio, I'll also see, increasing the debt ratio will also see decreasing financial leverage multiplier. So what we can see here is, again, our leverage has been declining slightly. The graphs have a downward slope to them. And indeed, you can also see, looking at the debt equity ratio, the very last year, 2023, of all the long-term debt that we've gathered, that is bonds, debt greater than 1 year, and equity, only 39% of that is long-term debt. So we have a company that has relatively low long-term debt. We also see in 2023, less than half of the assets, 49% only, have been purchased by using borrowed money. This implies a lower debt strategy of this company. When we think about our ability to handle debt, again, the higher the numbers, the better. Cash coverage is the same as the EBITDA coverage ratio, but we can see here that the numbers in general are greater than 1. A couple of years a little bit suspect here with TIE ratio, but again, we had a couple of bad years as well. So again, if you look at the number, does seem to be growing. So the company has lower debt, and of course, with lower debt, it's easier to cover the expenses of lower debt. So we would expect this to increase as debt decreases, since it's easier to cover those lower amounts of interest. Another number of interest is what we might refer to as the net debt to enterprise value. Enterprise value reflects the cost to buy the company and take the company private with zero debt. In other words, we're going to buy the company and we're going to have enough money to buy all the stock and pay off all the debt. So this is how much of that purchase price would go to the debt number. And again, you can see here that over time, although the number has been fairly stable in the past, it has started to decline. So in this example, after the transaction, if we did this in 2023, there would be 52% of the purchase price left over after we purchased the asset. And of course, certainly we would want this number to be lower rather than higher. We want to have more left over at the end. The next series of ratios to talk about are what we refer to as market value ratios. They reflect investor expectations. If the numbers are too high, we might think or assume that maybe this company is overvalued. Why? Because shareholders, investors, drive the stock price. If this number gets too high, it could be an indication that they are over optimistic. The price earnings ratio, for instance, shows how investors are willing, or how much investors are willing to pay for $1 of earnings. High growth companies like NVIDIA often have high PE ratios due to future earnings potential. So the potential is shown not in earnings per share, the potential is shown in the market price. So here we have the PE ratio for Coors that seems to be declining over time. So what seems to be happening with this number? Negative numbers are problematic. In publications, they typically don't show them if they're negative. And the average PE ratio of the S&P varies over time. So the current S&P 500 is around 27. And Coors here is sporting 13.8. So it's a pretty low number relative to the average. So what could that reflect? It could reflect that the company is in trouble, that shareholders just don't see the potential to pay more for the stock price. Another market value ratio is something called the market to book value ratio. Again, this number shows at less than 1, the company is cheaper to buy the stock than to build the company. This could make it a target for corporate raiders. It implies that shareholders, again, may not be optimistic about the future. Now, we do see a little bit of an upward trend, but in general, we're still having some questions about the value of this company. Is the stock price too low? And if it's too low, should we buy it? Could be a buying opportunity. Enterprise values are another set of ratios that can be reflective, if you will, of other types of ratios we've talked before. But these look at, rather than looking at sales and revenue, those profits and sales and profits and operating profit. These things look at how we compare the entire value of the company to some asset number. So the EV multiplier shows the enterprise value compared to the cash flow of the company. And this is measured by EBITDA, earnings before interest and taxes, plus depreciation and amortization. So it's a good cash flow number. If we wanted to buy this whole company and take it to zero debt, what is that number relative to the amount of cash flow it creates in the current year? Of course, we would like this number to be smaller rather than larger, right? Because smaller means the price relative to the cash created is less. Enterprise value to sales shows the cost of the firm compared to sales. How much sales are generated to help cover the EV? Again, we want more sales to cover that EV. We would like this number, again, to be smaller rather than larger. And then, of course, the enterprise value compared to operating profit, very similar to EBITDA, gives us a picture of how much profit is generated to help pay for the purchase price of this whole company. And again, although we see a few outliers, the remaining numbers are stable and basically show fairly little growth. So the enterprise values, or the relationship between the entire value of the company compared to these variables, has shown very little change over time. So let's think about some other types of analysis. We have something referred to as common size financial statements. We can have a balance sheet or an income statement. In this case, for a balance sheet, all the line items of the balance sheet are divided by total assets. On the income statement, all the line items are divided by sales. This will allow us to look at the importance of independent or individual line items within the financial statements. So a common size analysis standardizes financial statements, expressing each line as a percentage of sales or assets. If you want to compare the cost structure of fast food giants like McDonald's and Wendy's, this becomes easier using common size statements. So here is an excerpt of the common size income statement from Coors. What's the average cost of goods for the company? Well, if you look at the cost of goods sold number, you can see that it is roughly in the low 60s. 60% seems to be a pretty good average. What is the cost, the average cost of producing the products of Budweiser or some other alcoholic beverage company, right? What's the importance of interest expense, right? Again, if we look at interest expense, again, it's been fairly stable, but you notice it has been declining. Why? because we have declining debt. We can also look at the balance sheet, right? Has there been any change in the amount of the current assets of the firm? Well, if we look across the board, we can see the what? Cash has been growing. We see that receivables has been growing. We look at inventory. Again, inventory the last couple of years has seen a little bit of growth. So we see in general, as is reflected by total current assets, we see that current assets have been increasing. What about the total asset base? Let's look at plant and equipment. Plant and equipment, you can see, is fairly stable, a little bit of growth. What about the intangibles? Intangibles for some companies can be critical. And what we can see here is that the intangibles have actually been declining somewhat over the last several years. Not a great deal, but 5%, when you're talking about multi-billion-dollar companies, is a great amount of money. The percentage change analysis gives us a picture of how things go from year to year. It's kind of self-defining, right? So are sales increasing? Are the costs increasing? And again, we're going to find these numbers bounce all over the place. But in general, we want to look at the last couple of years. Well, what about sales? Sales actually increased by 9.35%. The cost of goods sold actually went down. So we're selling more stuff at a cheaper price, which must mean what? Gross profit increased substantially. Likewise with interest expense. We're seeing that every year interest expense has been decreasing because we're paying off the debt of the company. The last thing we want to talk about is something called the DuPont equation. This looks at the breakdown of return on equity into profit margin, asset turnover, and financial leverage. It helps managers see the interplay, if you will, between operations, the efficiency of using assets, and financing decisions. So the DuPont analysis shows us how the company can improve the returns to our owners by increasing profits, increasing efficiency, or borrowing more relative to equity. And if we look at Coors, what we can see is return on equity. Again, it is fairly variable, but what has been changing? The one thing we know that has not been changing is total asset turnover has been fairly steady. What about our debt level? Our debt level was fairly low. Financial leverage multiplier, it's been increasing a little bit, which means that debt has been decreasing. So we have slightly increasing efficiency. We have slightly decreasing leverage. And the factor that's making return on equity bounce all around is our profit margin. So we need to look at profits on how we can better stabilize those numbers over time. So in conclusion, right, ratio analysis isn't perfect. Seasonal businesses like retail can show some distorted figures depending on the time of the year. This is why we typically don't use quarterly financial statements. We want to use annual financial statements. And also companies can manipulate financials. Think about Enron, which used off-balance sheet entities to inflate performance and actually perpetrate a fraud against its customers and its shareholders. So we do have to be careful with the limits of what accounting can or what financial analysis can and cannot do. In addition, there are a lot of what we refer to as qualitative factors. Okay, there's greater risk if the revenues that we see are tied to a single customer, if they're tied to a single product, if we're relying on a single supplier. What about if a high percentage of our business is generated overseas? These things affect the quality of our analysis. So beyond the numbers, qualitative factors like dependence on a single supplier are crucial. A pharmaceutical company with a high percentage of sales from one blockbuster drug faces significant risk if a competitor launches a better alternative. So financial statement analysis equips us with tools to evaluate a company's performance and make strategic decisions. However, always complement quantitative analysis with qualitative insights to get a more complete picture. In the next videos, we're going to actually dive deeper into valuation metrics.